going to be very, very interesting. All right, so we've got a big week ahead of us. Being Thanksgiving, it's a short week. The bond markets are closed on Thursday and Friday. So we just have a 3-day work week. I'll be working all week if you guys need me. So even into the weekend, I'm not going anywhere. I'm thankful that I'm upright and above ground after what I went through this last couple of months. So I am very happy to be here and be in good health. And so I'll be working and relaxing here from home. So I'm going to get right into our special series today, kind of what we're thankful for. And first off, I'm thankful for everyone on this call and everyone that has been sending me referrals and business over the years. I really, really do appreciate you. I have to share my screen first in order for this to work, so bear with me one moment. Oop, wrong screen. All right, so welcome to today's Monday Tips and Tricks to be thankful for. I just put together some really random things that I thought were really, I don't know if you know, they're kind of secrets in the industry, maybe not, but I think you should know them. And they're really random, kind of all over the map, but I thought it'd be fun, kind of fun to share. So let's jump right into it. So first off, my favorites, I'm going to go through this. Now, if you put 10% down or more, if your buyers are putting 10% down or more, before you make the offer, so before you write the contract and send it over to the seller's agent, I can run it automated. I can run that loan automated through our system before you make the offer to see if we can get an appraisal waiver. If we do, then you can make that offer without an appraisal contingency. So that may put you in a much better position than you were before and hopefully beat out some of the other offers that are out there. So keep that in mind. We need you to do this before you make the offer. It only takes me about 5 to 10 minutes to run this with the address. And I'm one of the very few lenders that's able to do this without triggering the disclosure process. So a lot of lenders don't do it because it'll trigger once you do that, the disclosure process, and then you have to cancel out the whole loan, redo the whole loan. We don't have to do that. So really cool tip. Next little tip, also part of the contingencies is you can make an offer eliminating the financing contingency as well. If we do the pre-approval through our True Approve program up front, it's basically a fully approved loan before you make the offer. So we're coming up on the buying season. You know what happens every spring. It gets crazy. Make sure our buyers are set up so that we're fully approved through underwriting and we are running those DU to get the appraisal waivers. That way we can make an offer with no financing contingency, no appraisal contingency, and we can close in 2 weeks. So this is going to be really important when we get really busy again, because it's going to happen, guys. Rates are going to pop down. And then the buying season is going to be here and it's going to be kind of chaotic. So fingers crossed those rates come down, right? And let's see, what is my next trick? Credit boosting. Okay, I don't know if you guys know this, but for every 20 points that I'm able to get boosted in credit score, that'll save about an eighth in rate on a conventional loan. That's a big chunk. So there's a lot of people that have credit reports that are not reporting properly. So using my FICOboost.com, if you go there, FICOboost.com, that's me. I can do a free credit upgrade and get sometimes up to 100 points better on their credit scores to get a better rate. So if somebody's really sensitive to rate and their credit score maybe isn't the best, I can work with them ahead of time to really get it to where it needs to be to get the best rate possible. Didn't know if you knew kind of how much the credit score, how much that would translate to rate, but it makes a huge difference. Oop, I skipped one. So a lot of people ask, well, how much can I qualify for? There's a really, really simple formula I want you guys to jot down. Total income before taxes divided by your total debts that you have and only borrowed money, including the new mortgage. So you take your new mortgage payment plus all the minimum payments you have on money that's borrowed. And I'm not talking about services like cell phones. I'm talking about borrowed money, all of those minimum payments. For FHA, that max is 55%. So if you're wondering how much you can qualify for, if your income is $10,000 a month, your total debts can't exceed 5,500 or 55%. And that's your max qualifying. So if you're wondering how much you qualify for, this formula is perfect for that. It's just a simple down and dirty way of figuring it out. Now, for conventional, they go up to 50. So your new mortgage with all the taxes, insurance, HOA, plus your minimum payments on debt for conventional can't exceed 50%. And then jumbo is 43%. So this is a really down and dirty. If you just have a couple questions, people going through your open houses, wanting to know how much they can qualify for, you can use this formula to do a quick, you know what, your payment on this, let's look at the calculator. Looks like it'd be 3,500. You make 10,000. Yeah, you qualify if that's your only debt. So really fun to have, really simple. So you're on the run, you can use it. Now, this is a tip that I don't think anybody uses. If you are a listing agent and you're working with the buyer that has a lot of equity and you're thinking about potential selling it in 3 to 6 months, it is a really good idea for them to get a big home equity line as much as they can borrow and not use it and just let it sit there. First of all, they're free. Home equity lines don't cost you anything. Second off, if you run into a position where you want to buy a home right away, but your money is wrapped up in your property, you now can tap into that equity without doing a bridge loan. Okay. And if you don't use it, you don't make payments. You only make payments on that if you actually take a draw from that home equity line. So it's a fantastic tool to prepare your buyers or your sellers for the next step in a free way. And it's free to do a home equity line. And it's a great way to just prep to be flexible for down payment as you move forward. And didn't know if you knew this either, but only one person needs to be a first-time home buyer that's on the transaction in order to take advantage of first-time home buyer programs. I'm not sure if you knew that. So if you have somebody that owns their own home and they bought a home when they were single and now they're married and their spouse is a first-time home buyer, they can rent that other home out and buy a new home as a first-time home buyer. So kind of a cool trick. Didn't know if you knew that. And then another fun thing, and this is for parents like me, helping their children buy a home or helping somebody else in the family buy a home. The person living in the home that's going to be treating it as a primary residence, they don't have to have any income. The cosigner can carry the entire thing. Down payment, income, everything. A cosigner can cover everything. So if you have a young student that's thinking about going to college that has a housing expense, and I believe me, I'm looking at them all right now because I've got 2 kids in the college age. So it's expensive. It's like $1,200 to $1,800 a month, depending on where you go for housing. It's crazy. So this is a great way for them to get into a home, and because they don't need income to qualify, you yourself can have that as income, and then they can rent out rooms to their friends and live rent free. Super cool life hack or house hack.
Sean?
Yes.
Now, would you take title in the name of your child, or is the home in your name? And then it's because I didn't think if you buy it that your kids can be your own renters.
Oh yeah, they would be owners. So the child would be the number one primary borrower on that transaction. Their name is on title, and so is the co-borrower. So you would be on it together.
But they're getting it based on your credit history and your income. Interesting.
That is exactly right. But we do use that borrower's credit. So hopefully they've got good credit. They're probably not going to have much. So if you do have kids, I highly recommend you putting them on some of your credit cards as an authorized user to get them some immediate credit, or start building that right away. But you can carry them full credit wise and income wise. It's still their primary residence, so you get really good rates. They're on the mortgage, they're building credit that way, and you're carrying them through the whole transaction. So pretty cool program. Didn't know if you guys knew this, but I did this for my daughter and for my son. So it works great. I know a really good lender. So if you guys need one, I know one. He's really good. So didn't know if you knew this either. If you're stuck dealing with an out-of-state lender because they have a rate that their borrowers like, most lenders do rate match. Now, some are like $10 an hour employees working in a call center in a different state like better.com, and they're really a terrible lender. They offer really good deals, but they might close in 90 days. So not good for purchases. Refis, go for it, but it's going to be a really bad headache. So keep in mind that most lenders do price match or rate match. So I just wanted to make sure you guys knew that. So if you're stuck, you can get out of jail easy. Now, loan recasts. This comes up a lot. A loan recast, I think, is one of the best tools that's out there for people that are doing like a bridge loan scenario, or they're buying a home now and then they're selling another house and they want to use a huge chunk to put down towards their principal. Instead of refinancing, you can do a recast. It's basically a huge lump sum that's put towards your principal, and you work with the lender to recalculate your new mortgage payment based on the lower balance. Typically, if you just make extra payments, it doesn't change your payment. You stay on that amortization schedule and you don't deviate. If you do a loan recast, it'll recalculate your payment based on the terms that you already have. So you can drop your payment significantly and put that money to good use. So usually there's a couple $100 charge to do this, but almost every lender does it. If they don't do it, I would be shocked. But a great tip, great tool, especially if you're coming into money or if you're doing somewhat of a mini bridge type transaction. And then we do have loans, guys, that if you have a customer that is not qualified, it's a great buyer. They're putting 25% down or more, but they just don't qualify. Maybe they created their brand new company that they just started on their own, or they just write off everything and they can't qualify. We do have no employment and no income loans available. So I call it a Band-Aid loan, maybe a 6-month to a 2-year period of time where you pay a little bit higher rate, but you can do it. Literally, there's nothing on the application other than assets and your credit. There's zero employment, it's blank. There's zero income numbers, it's blank. And you can do a purchase transaction that way. So didn't know if you knew that was available, but keep that in your quiver as you're listening to your buyers' situations.
Sean, is that the DSCR loan?
No, that's actually what's called a no ratio. So a DSCR is another one that's very good as well. That's for rental properties, where we only look at the income for that property to qualify. So as an example, if you're buying a home and the mortgage is $4,000, that's the mortgage payment. If you can show through comps that property will rent for $4,000 equal to the mortgage amount or higher, so it cash flows, that's the only, other than credit and verifying assets, that's the only income qualifier. So there's no income on the application at all, just like the other one. And there's no employment on the application at all. It's only based on what it can rent for. And that's that DSCR. Super cool program.
Sean, which one is cheaper?
DSCR is the cheaper of the two.
Got it. Thanks.
Absolutely. And then another trick. Hey, come here. Stop. Sorry. Another trick that I don't know you know. So if you ever run into seasoning issues, meaning you've got a buyer that has $50,000 towards down payment, but their lender didn't ask them where the money was right now, and you go in to buy a home and they're like, yeah, the money's in my safe. Well, you can't use that money unless it's been in an institution for 60 days. However, if you have a family member that is willing to do a gift to you, and they wire the money from their account directly into escrow, if you wire it directly into escrow, that's a very important piece. And that matches their gift letter for the dollar amount in the account. we don't need to look at their bank statement history to see how long that money's been there. So you could give it to your parents and then they could gift it to you. No, I'm not teaching you how to money launder. I promise you. But it is a loophole that we have in the mortgage industry to get out of the way of unseasoned funds. So keep that as a little nugget in your back pocket if you ever run into that scenario.
Sean, Helen and Jenny both have questions
Yes.
in the chat.
Let me look at the chat real fast. Hold on one second. So what is the interest like on something like that? I believe, Helen, that may be for the no income verification loan. Rates are typically 2% to 2.5% higher than a traditional rate at that time. So if rates are 7, you're at 9.5. Not the best, but it gets them into a home for a short period of time until they can qualify normally, and then we'll do a no lender fee refinance. That's why I call it a Band-Aid loan. What do you have to put down for the DSCR? So for that program, typically you want to do 20% or more down. Keep in mind it has to cash flow. So the less you put down, the less opportunity or the less the odds are that it will cash flow. But there are DSCR loans available with less down, but they typically don't work because they don't cash flow. So good questions. See if there's any other I missed. Nope. Perfect. And then do the gift funds, guys, that saved me so many times. You have no idea when people just say, oh yeah, it's in the bank, and it's not. It's in their bank of the mattress, but it helps a lot. All right. This is another house hack. You only have to live in your house 12 months before you rent it out and buy another one. So if you have young buyers or young people that are entrepreneur in nature and they want to build a real estate portfolio, you can literally buy a new primary residence every 12 months. And you can just buy and then live in it a year, rent it out, buy, live in it a year, rent it out, buy, and just do it over and over and over and over to create a really solid real estate portfolio. So didn't know if you knew that, but I wanted to make sure you did. And then assumable loans are very attractive, especially in a high interest rate environment. Only FHA and VA loans are assumable. There's no such thing as a conventional loan that's assumable. So if you want to know if the loan's assumable, you just need to know if it's an FHA or a VA loan first. And then anyone can assume those if the seller is willing to go down that rabbit hole, because it takes a long time to get those closed, because you do work with the lender that is already attached to that loan. So not sure if you knew that. All right, so now we're back into the mortgage update, kind of see what's happening right now in the interest rate environment. And first off, Scott Bessett, he is our new Treasury Secretary that has been appointed by the new administration. Great person for this job. The markets absolutely love the call this morning. Very non-partisan, very middle of the road, runs a massive hedge fund, understands economics very well, super intelligent guy, understands the dangers and the positive pieces of tariffs, which is a huge bonus, especially in this market when I know there's a lot of tariffs that are going to be instituted, but this guy will not let it happen unless it's very good for our monetary policy, inflation, and everything else. So super pick, great pick. The markets love him. And let's see what's happening with the markets as we see. So as you can look at it right here, last Friday, we had we bounced off. Remember we said, hold the line. We wanted to hold the line down here. We held it strong. Now we're going in the direction we all like. And that's where rates are getting better when the bond markets improve. So last Friday, we had a little bit of improvement. And today we pierced all the way through the 25-day moving average, all the way through the 200-day moving average. And we're above it right now. That's a great sign. And rates are about 1/8 better now because of that. So really good to see. Here's the 10-year. Remember, when the 10-year goes down, so does the 30-year fixed, and mortgage rates go down. And look at this big jump. We went below a Fibonacci level and below the 25-day moving average. Fantastic. I hope this continues because we have a lot more room to go on both sides. So if you look at how much room we have to go on the Fannie Mae 30-year bond, we have a lot of room to get to the next level. So let's Hope and pray that continues because we can see some really good rate improvement. So as of this morning, now last week we're at 7.05. Now we're at 7.03 from Friday, but because of today's moves, we're going to break under 7%. We're going to be in the high sixes by the end of the day today. So yay, exciting. Always nice to have a little bit of positive energy going into a holiday. Let's hope it continues, and that's just good news for buyers. So this week's market movers, this Wednesday is huge, guys, but today we had a treasury auction. It went okay. Tomorrow we have Case-Shiller home price indices. We have consumer confidence. We have a Richmond manufacturing index that's coming out. We have new home sales. We have a 5-year auction, and we have the Fed minutes that are going to be read and released. So a lot going on tomorrow, but look at Wednesday. We have the PCE, the personal consumption expenditure. We have the year-over-year and the month-over-month. Now, this is the inflation measurement. This is massive. This is going to give us really a good peek at what is to come. But here's the problem. This is an average of the last 12 months. The number that's coming out for this month-over-month is going to be 0.2. It's going to be basically 0.2. We are taking that 0.2 and we're replacing what was put into that formula, the average, 12 months ago. Now, 12 months ago, it was 0. So if it's an average of the last 12 months, you remove a 0 and add a 0.2. What does that mean? It means inflation is going to go up. Now, we know that 0.2 is a pretty good reading. So the markets shouldn't go crazy when they see the year-over-year go up a little bit because they understand where it is month over month. But you will hear on the news inflation going up. You'll hear it, but it is on average, but we are at a nice clip of 0.2. So that's basically 2.4% annual inflation, which is good. It's kind of where it's not where they want to be yet, but it's pretty darn good. Now, if you add back in energy and a bunch of other things, it's higher than that, but that's another conversation. Initial jobless claims are coming out. I'm going to spend a quick minute on this. The BLS jobs numbers, the Bureau of Labor and Statistics, they were wrong by 1.2 million jobs over the last 12 months. Let that sink in. So when I talk about rates are very, very dependent, mortgage rates are very dependent on employment, and every employment report for the last 12 months has been 100,000 jobs inflated. That makes me mad because that means that if they would have been real with these numbers, which the census has now come out and validated that they were wrong, if they would have been real, rates would be much better than they are right now. That's the frustrating part about it. It is what it is. Somebody needs to change the reporting and how it's done. But until then, we're going to look at this initial jobless claims and hold it with a grain of salt because guess who puts it together? The BLS, and they've been wrong by 100,000 jobs every month for the past 12 months. We also have continuing jobless claims. Those are people on unemployment. If those numbers continue to go higher or if they stay at an elevated pace, that means people are staying on unemployment for longer. That's not a good sign for the economy, but it would be good for mortgage rates. GDP, that's coming out. A lot of stuff, guys. Durable goods orders, those are like cars and actual like big items like washing machines, dryers. Then the core PCE, the Fed minutes being talked about, personal spending, and a 7-year auction. So this Wednesday before Thanksgiving is going to be crazy. So I'm going to be looking very carefully at that day to see whether we float or lock. But that's what's going on in the markets. Don't forget about our $5,000 pre-approval guarantee. And we can eliminate those financing contingencies and appraisal contingencies on offers moving forward. So any questions for me as we move into the holiday, into the Thanksgiving week? Don't be shy.
I have one, Sean, it's Michelle.
Sure, Michelle.
Can you review, you guys are still doing those programs that, the buy downs, are you still doing those?
Absolutely.
Okay, so
Yes.
remind me again, because somebody called there, I have a listing that's gonna be a buyer is gonna be getting financing, I'm guessing. So if we do that, or they ask, are we doing concessions? Can you remind me, like, if you want to buy it on a point, how much that generally costs?
So 1%, 1 point would be 1% of their purchase price is what they
Okay.
typically ask for. On the
Okay.
loan side, when you do 1 discount point, typically you get a quarter to 3/8 better in rate. So if they ask for 3 points, 3%, they'll get enough for maybe 1% or 3/4 lower in rate.
Oh,
That's
okay.
kind of how that shakes out. There's also, and that's a permanent rate buy down. There's also 3-2-1 buy downs. There's 2-1 buy downs, and there's 1-1 buy downs, which are temporary rate buy downs, and only the seller can pay for those. And then, so depending on how much they're asking for, they could use that money for a temporary or a permanent buy down.
Okay, thank you.
Yeah, you're very welcome. Good question. Super popular right now. Keep in mind, if you do a 3-2-1 buy down, it's temporary. The sellers give a lump sum to the buyer. That money is put into a piggy bank, and their payments are supplemented with that every month to be equal to a rate that's 3% lower the first year. If they refinance when there's still money in that piggy bank, they get that money back. It's a pretty cool program. So anyhow, I can go on that and spend an hour on that program if you wanted to. Any other questions?
Wait, who gets the money back? Because the seller gave it and you've closed on the house already, so then the buyer gets it
The
back?
buyer gets it. So if the seller gives them 3% to do a temporary rate buy down,
Mhm,
it's now the buyer's money.
Gotcha.
That's in that piggy bank that's attached to their loan. The rate actually doesn't go lower on that 3-2-1 buy down. The first year, the payment is equal to a rate that's 3% below the actual rate. So what they do is they dip into the piggy bank to supplement the payment to make sure to show the payment that is equal to a rate that's 3% below their actual rate. But if they're dipping into it and they don't use it all, that money doesn't get wasted. It actually gets applied to the loan balance on the buyer's loan to lower the loan balance if it's refinanced. So pretty good program. The money's not wasted if you refinance, but if a permanent rate buy down, that money's gone. So if you have a 6.125 rate that you spent 10 grand on, and the rates drop to 5 and you refinance, that money was kind of wasted. Good question though. Any other questions? All right, well, next time we talk, we will all be a few pounds heavier from the pumpkin pie and the turkey or ham or whatever you guys prefer. Enjoy your week, guys. If you need me, I'll be working through the week. And as always, I'm available weekends and evenings as well. So you guys have a phenomenal week and we'll be in touch. You're very
Thank
welcome.
you, Sean. Have a good.
Anytime. You guys have a
Thanksgiving.
great day.
Thanks, Sean. This was awesome.
You got it. Have a great
Yeah.
day.
Really good, John. Thank you.
Not a
Thanks,
problem.
Sean.